Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Eaton Corporation, ticker ETN. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $64 billion, enterprise value of $71 billion. You can see about $7 billion in net debt on this business, but it really only contributes about 10% of the overall enterprise value. Equity is about 90%. So only a slight amount of leverage here. This is the electrical equipment industry. They operate as a power management company worldwide. They have an Electrical Americas, Electrical Global segment. They provide electrical components, industrial components, power distribution assemblies, residential products. Let's see. It has an aerospace segment that offers pumps, motors, hydraulic power units, hoses, fittings. Various things like that. Also has a vehicle segment offering transmission clutches, hybrid power systems, superchargers, and an e-mobility segment for voltage inverters, converters, fuses, everything for, it looks like, electric vehicles and hybrid systems. So pretty diversified. You can see auto, you can see aerospace. They also have various power distribution components, industrial pieces there. It tells us a little bit about what this business is doing, and they're both in America and globally. Beta of 1.1 isn't really significant, pretty normal beta. Now, return on invested capital, first thing I see that I like is you have 20 straight years of profits. Anytime you have 20 straight years of profits, it's an instant sign that the company is more likely to be a high quality business. The second thing I notice is that they are somewhat cyclical. Now, I think part of this is driven by the fact that their exposure to automotive, exposure to aerospace, they're going to have some cyclical components. They're going to be affected by recessions. And so you see the low points here in 2009, 2002 was a recession, 2009 was a recession. You see 2020 is a low point. That was a recession due to COVID. You have the financial crisis, you have the dot-com bust. So they're going to bottom during recessions and have these kind of cycles. It's very easy to see these big waves, but you got to be some really nice numbers up in 2006 at a 14% return on invested capital. You bottom at 3%. Why is that important that you bottom at 3%? Because it means you didn't lose money in 2009. You didn't lose money in 2020. That's important to note, that even though you have some downturns, you're not losing money. That's a very, very good sign. Also, you generally have been trending upward since 2012. That's kind of a nice movement. 6%, 7%, 7%, 8%, 8%, 8%, 9%, kind of an improving return on capital business over that decade. You kind of like to see that because it's showing maybe some operating leverage, maybe the fact that they're getting better performance out of their assets. That's generally a good thing to see. Although it looks like they had better performance, of course, in the previous decade where they got up to like this 14% number, and they've never really recovered to that since the financial crisis. But overall, pretty cyclical. But there is some good signs here because even in the bottom of the cycles, they're not losing money, and they are having some years above this 10% line. Now, on the other hand, over the last decade, they've really not been above the 10% line. They only have 1 year in 2017. That's less of a positive. You'd like to see at least half the years above it, so you could kind of average out at that 10% number, and they're a little bit below that. You see that's there with their 10-year median returns of 8.1% return on invested capital. Now, I mentioned they have some leverage, and that leverage is taking the return on invested capital from 8% up to about 12.7%. That's a good sign, but I'd really like this return on equity to be about a 15% number. 15% is important because I want to get a 10 to 15% return from my investments. And by getting a 15% number, I'm really setting a good metric to allow some losses for dividends and the inability to fully reinvest that capital. At 12%, you're in a good range, but you'd really like it to be a little bit higher. Overall, though, those numbers are acceptable, but none of them are outstanding. You're more on the average side. So high quality from the 20 years of straight profits, average from the cyclicality. Most companies are cyclical. Average here with these numbers as well. The unfortunate part is when we get to valuation. Valuation seems really, really high. You have a PE of 28. So we need to take a look down here, and we can take a look at this 2021 number of $3 per share. $3 per share, $161 here. You can clearly see that that's about 30 times. So it is running pretty stably off that number. And also what you see here is this number isn't exceptional. It's not like $3 per share is, substantially lower than their average earnings. Actually, $3 per share is a peak earnings number. Now, what I do like looking at this earnings stream is that it's pretty steady. You're going up almost every single year. It actually looks like you go up every single year. That's actually, dividends. We need to backtrack. I'm looking at the dividends number. I do like the dividends track. Okay, let's look at this $5.34 per share. So $5.34 per share, you multiply that by 30. That's in the same range. That's your 28. Okay, so now $5.34 per share. Is that a low number relative to the last period of earnings? No. It's higher than 2020. It's higher than 2019. It's higher than 2018. It is lower than a 2017 number, which is this peak here. But 2017 is this weird year with the Tax Cuts and Jobs Act. You have to be really careful about using this number as a sustainable number. So I'm not going to use the 2017 number. I am going to say that this is probably a pretty normal number, which means that this valuation is truly high. How do you justify a PE of 28? PE of 28 means that your earnings yield is about 3.5%. So if I want a double-digit return and I have a 3.5% earnings yield, I need to be growing revenue at about 6.5% at least to justify that. And really, that's not enough. You really want double-digit revenue growth to justify a PE of 28, something like 10 to 15% revenue growth per year with EPS growth matching or exceeding that would justify this sort of PE ratio. And part of the problem is you have this high PE ratio and you have debt on it. So it's a leveraged PE. That makes it just even more difficult to justify when you only have a 2% revenue growth rate. What does a 2% growth rate mean? It means you've gone from $16 billion in revenue to $19.6 billion in revenue over a 10-year period. You've really only grown 20% over that 10-year period. That's how you get something like this, where in 2012, you had a $3.46 EPS, and in 2020, you had a $3.49 EPS. Now, in 2012 was a good year, and in 2020 was a recessionary year, so you have to take that with a grain of salt. But you can see how over an 8-year period, you've really, not gone anywhere. And that's a big problem for a business like this. You really want to see stronger growth on the EPS line. Now, they are paying 40 to 50% of their earnings out in dividends. That is a positive for shareholders because it means that you don't have to actually justify your whole market cap with the revenue growth. You have some backup there from getting that dividend payout over time, but it does mean that they're not being able to fully reinvest at this return on equity. So you should expect your returns to be lower than the return on equity. This is kind of be your upper end of your possible return is a 12.7%. Your lower end is somewhere in this 3.5% range. So between 3.5%, 12.5%, that's going to be like the boundary of what you can expect for the returns here. And because you're, saying half your cash flow is going to dividends, then really let's cut this number in half. So then we say, okay, we have 6.5% return on equity, or 6.5%, returns from maybe our reinvestments and an additional earnings yield here of, 2%. So then maybe we're getting an 8.5% return. That's not terrible, but you're somewhere in that 8 or 9% return range based upon what you're seeing here. You could be higher if your revenue was growing faster, if your EPS was growing faster, but it's not. Now, if you're enjoying this analysis so far, hit that like button. Don't forget to subscribe. We're about to go into the income statement. So, income statement. One thing you can see that's good is the SG&A has been relatively flat over the last decade, so they've been able to maintain and manage their growth in expenses very well. They are growing this other operating expenses number. I don't really know what's driving that, but you can see that they're really working to maintain their expenses down, which they need to because they've not been growing their revenue very quickly. Their net interest income is lower now than it was a decade ago, so I'm going to see if later on if they've been paying down their debt. That would be a good sign. Another thing with the changes here, the cyclicality, is you see a lot of numbers here on this other non-operating income line, and that's changing a lot of what this is. And as I said, 2017 has a $1 billion other non-operating income. This is probably tax related or something along those lines, or maybe it's not. But regardless, you need to take that $1 billion out of this net income number, and then you have the same sort of earnings as 2016, which would put it in the $4 range. So really, this is not a $6 earnings per share number. The other thing that's a downside here, though, is you have your shares outstanding have grown over time. A big growth that appeared occurred between 2012 and 2013. You had a big, massive dilution rate. But since then, you have been buying back shares. So that is a little bit encouraging. So you basically had about a 30 or 40% dilution in 1 year. And then over the next 9 years, you've retired 15% of the shares. So I like that. I like that they've been buying back shares steadily. That's a good sign for their capital allocation. Balance sheet. Let's see if we can see something interesting here. So you've grown your PP&E about 50%, which is that in line? That's less certainly than your net income growth, so that's a good sign. Better returns there. Although you can see again this big acquisition taking place. That's what that dilution act was for. You had about $9 billion added in terms of goodwill, $5 billion added in terms of intangibles. That's about $14 billion, $13 billion in additional goodwill, intangible assets, and property, plant, and equipment. That's a big, doubling of their asset base. And then since then, they've kind of maintained a stable asset base over time. So that's a good sign there. Although, let's see. They've also not grown their net income that much since then. They've grown their pre-tax income a little bit, 50%, but not a ton. Let's go back to the balance sheet. Long-term debt, you can see they took on $6 billion in debt for that acquisition, but they've been paying it down over time. One of the things in my most recent one is I looked at Eastman, and then they were kind of retiring debt at the same time that they're paying out dividends, the same time they're buying back stock, and this company's been doing the same thing. They made a back acquisition, but then they've been paying it down, and you like to see that they pay down their debts. Cash flow, because one of the things that this will do is it should have their shareholders' equity kind of growing or staying. So it looks like they've been actually dumping that shareholders' equity. Let's see, cash flow. Here's what we see. Okay, look. So since 2014, you've bought back share every year. You've retired debt, not every year. You actually took on some more debt in 2019 and 2021. And you've been paying dividends every year. So when you're putting all this cash flow out to shareholders, out to paying back debt, it just confirms you have positive cash flow from operations. You can trust this cash flow numbers. It's truly free cash flow because they're able to send that out to shareholders without harming their business. That's a really good sign. Another thing that's kind of nice about why they've been drawing down their asset base is you can see this high depreciation amortization number, $900 million, $1 billion, basically $900 million a year in depreciation amortization. And yet every year since 2013, they've actually had a lower PP&E investment number, which means that they're actually reinvesting less than what they already have there, which is allowing them to get better returns over time. This differential here between the PP&E and the depreciation amortization is a big reason for this steady improvement in return on invested capital. When you have this slow and steady improvement here, it's caused by something like this, where you're investing less money into your PP&E than you had in the past, and yet you're still able to maintain or grow your earnings. That really drives a high return on invested capital. It drives free cash flow, which is all this numbers down here that can be paid out to shareholders. And it's a very good sign for the profitability of business. Now, it can be a red flag as well if they're not investing enough to truly maintain their assets and they're just deferring reinvestment. That would require a more in-depth look. But on the front, it looks like it's just improving the return on invested capital, which can be really, really good for shareholders. So Eaton is what I would call an average to good company in the S&P 500. What I really like about it is you have 20 straight years of profits. This puts a nice floor on your potential returns. When you're profitable every year, then you have a lot of free cash flow like they have. They're able to pay it out to shareholders. That gives you the floor. That gives you dividends you're going to be able to get and spend or reinvest. The buybacks are going to cause your percent ownership in the company to increase, and the debt pay down is going to just increase your margin of safety, make it safer for you over time holding the stock. So you really like to see a company sending a lot of free cash flow back to shareholders like that while they're still able to grow. Now, what do I not like about this company? I don't like the valuation. The valuation is just way too high for a company with 2% revenue growth. A company with revenue growth in this range deserves a much lower PE ratio, something on the range of like 12 to 13. Maybe let's call it 14, and you could just say the company is maybe 2 times higher than what I'd like to pay. So, I mean, it's $161 a share now. Let's say it should be like $81 a share, and then it gets interesting because you're at a PE below 15, and then that more matches up with what your revenue and EPS growth rate is. When you combine that revenue growth rate with the EPS growth rate, you're getting that 1 to 2% boost from your share buybacks. Now you get interesting at a PE of 14. That's more a fair value for this company. And then that would more be in line with these signs of return on equity being more of a price to book of 2. That's just a much better price to be paying for a business like this. Now, it's just also just fairly low risk. I mean, it is cyclical. But if they are able to reduce that cyclicality over time, or if they're able to continue reinvesting less than they have in the past while able to still grow their earnings, then you should see this return on invested capital grow. I mean, if you start thinking and this continues for just a couple more years, your return on invested capital is going to go above 10%. If they can be a little bit more leveraged, maybe your return on equity goes above 15%. The company becomes very interesting. It's not yet at the point where I'm going to put it on my watch list, but it's the type of company where if you were to come back in a year or two, or if you think it's already going to get there, then getting in ahead of time before that improvement means you're likely to get some valuation changes. Although, again, that assumes, of course, that you're able to get it at a good price, and I just think it's a little high at the current price. If you enjoyed this video, if you found this content useful, hit that like button. Don't forget to be a subscriber. Your likes and subscribe tell YouTube you're enjoying the content, that you want to see more of it, that you would like my content to be distributed to a wider audience. So I really appreciate that. If you would like to use this tool, this is quickfs.net. Please consider using the affiliate link in the description below. It is the first link in the description, and that'll take you there if you sign up using my link for a free or a paid account. Free accounts are available. Then you can use this software, and I can receive a commission for sending you to them. I don't use this I use this software for myself. I don't recommend something I'm not going to use. This is what I like to use to look at companies. I hope you found it useful. Thank you for listening. Until next time, stop paying fees, start building wealth.